All right, today we are going to have some fun as we're going to look at some very detailed and technical information. What we're going to look at is a life insurance illustration with a loan taken and then repaid over a period of time. So if you like to see loans taken and repaid on the actual life insurance company's literature, on the illustration that you receive from the life insurance carrier, we're going to go through that in this video. And what I will begin with is, it is technical. It can be extremely confusing. You really have to go through it slowly and thoroughly to ensure all of the numbers line up, but we'll do that. So what we're going to look at is a loan scenario similar to what we had looked at in one of the prior videos where we demonstrated using a whole life insurance policy like a personal line of credit with the individual who is 55 years old, funded the policy with $1 million over 4 years, and we had this. So what we've got on the left is a growth illustration, which shows what his policy looks like if he just parks money and lets it sit and grow, compared to the example on the right, where we have the $500,000 loan coming out. We repay it at $100K per year. But if you look at your cash value at year 7, highlighted in that light yellow beige color, and then also in year 14, you'll notice that it matches the examples to the left, because your money continues to compound when you take a loan and repay. So now we're going to look under the hood. We're going to look at the actual illustration so we can see how this works. So let's begin with what we've got on the left, the growth illustration. So this is the growth illustration, and we've got 28 pages here. To the far right, you can see 1 out of 28. A lot of information. And if we look at the summary page, this will give us information that looks a lot like what we have on Excel, just a simplified format. But if we go down to the detailed ledgers and look at the actual breakdown of the policy, we've got the tabular values, which I'm not a fan of because they do not display the custom funding illustration we put together, which was $250K per year for 4 years. For example, one thing here is it assumes we keep on making premium payments afterwards, where this individual's intention is to stop after 4 years. So here's the growth illustration. I'm going to go through this quite quickly, and then we'll transition into the loan illustration. So the $250K per year, how to tell that both illustrations are the exact same illustration, because we want to make sure that's the case. We want to make sure the policy that we like for maximum cash value growth is the same policy we're looking at when it comes to policy loans. Of the $250 per year, here's your premium, $25,000 and change. What you can take note of here is look at your age 60 cash value and death benefit. Cash value is $1,032,000. Death benefit is just over $3 million, $3,009,000. So keep those numbers in mind, and let's look at the loan illustration. We'll go down to the supplemental values. Here we go. $250 per year going in for 4 years. There's your premium. Cash value be over here under net cash value. Year 5, there's your cash value, $1,032,000. Where's the death benefit? When you run loans with some insurance companies, too many columns are populated and they don't all fit on one page. So we have to go to the next page where we see part 2, and there's your net death benefit. Year 5, just over $3 million. This is a big reason why we put it on Excel in addition to sending these detailed illustrations, because a lot of information here. So let's just go through it one column at a time here. And I'll skip the first 2 columns because everyone knows what that means. Year and age, we'll skip that. Annual outlay, $250,000 per year for 4 years. That's how much you funded the policy with. So you funded it with a total of $1 million. This consists of your premium and PUA payments. Now, for the next 3 years, there is no activity with the policy. We didn't pay anything in. and we didn't borrow anything out. Year 8, we see that negative $500,000 in the annual outlay column. Why this is here, that negative 500K, is because this represents money that's coming from the insurance company to you. Think of it this way. The $250 per year annual outlay, this is you outlaying money from your pocket to the insurance company. You're funding your life insurance policy. Year 8, it's a negative because this is money coming from the policy to you. All right, so this is $500,000 you received. It was sent via check or direct deposit in your bank account. Now, after that, what do we see in the annual outlay column? 100K per year, and the last year is $96,000 and change. What this represents are the loan repayments. And for this particular illustration, we assume you are paying a net of 100K per year that is first applied toward the interest, and the rest is applied toward the principal. Okay. So again, first 4 years, those are your premium and PUA deposits. Year 8 is the loan that you took. That's money sent to you. And then down here are our loan repayments. Next column, we've got annual loan here. When you see that term, what goes through your mind? Loan, money I receive. So year 8 is pretty straightforward. There's the $500,000 loaned to me from the insurance company in this case. But what's going on after that? Like, what's up with these negatives? Right? You got negative $73,550, and it goes up each year. Here's what's going on here. So the loan interest in this example for the first year is $26,000 and change. We actually put that on the Excel workbook, $26,450. Keep that in mind, $26,450. So the first year, you paid $100,000 toward the loan principal, or toward the loan balance. So year 9, 100K toward the loan. You know that $26,450 went toward the loan interest. So let's do this, 100,000 minus 26,450. And that comes out to what? Look at that. And that comes out to what? 73,550. 73,550. What this represents is from your $100,000, how much was applied to the loan principal. Because of that 100K, the first 26,450 went to loan interest. Everything above that is applied to the loan principal. So when you see a negative number in the annual loan column, that represents how much you are paying down the actual loan principal, which you can see in this column to the far right. Total outstanding loan and year, but we'll hit on that in a little bit. So again, annual loan, when we see numbers without a minus sign here, that's money you're receiving. And then this represents the loan being paid down, specifically the loan principal. Annual surrender, this represents the premium payment that you're not paying, but the policy is paying through dividends and interest. So for years 5 through 7, it's $29,000 and change. That represents the base premium plus the cost of the term insurance rider, the renewable term rider down here. Add those two together, $29,355. After year 7, we dropped the term rider and it paid just the base premium on its own. We could even reduce that or eliminate it through a reduced paid up, but in this example, we did not do that. But that's what the surrender column represents. Annual net outlay is the same thing as annual outlay. You'll see those numbers match. Annual dividend just represents the dividends being applied to your policy. Remember that the guaranteed piece is not included in that column. That's the surplus only. Basic policy cash value. This column does not help very much in my opinion. This represents the cash value buildup from base premium payments only. Total cash value of additions represents money you add into PUAs, which with a MassMutual illustration, that would be through AILR payments and also LISR payments after fees are assessed. So this simply represents how much of your PUA payment it shows up in cash value net, and then as time passes and dividends are applied, it also factors in that. What this does not include, the total cash value of additions column, it does not include any cash value buildup from base premium dollars. That's in the column prior in the basic policy cash value end year. Very easy to follow, right? Then we've got the total outstanding loan. So here, when you took the $500,000 loan, there's your balance, $500K. But then as we apply $100K per year toward it, and we first pay the interest, the rest goes toward the principal. Look at this. We see the loan shrink. The last year, your payment out of pocket is $96,000 and change. The year prior, the loan balance was $91,000 and change. Why it's different there, why it's higher, is because we're also paying the loan interest. So this is a big reason I like to put it on Excel just to get everything in order here. So if we look at this, there's your loan balance of $91,000 and change. Then you've got the loan interest of $48.26. Add the two together, you'll get that $96.55. Just to explain the math a little bit. Then you've got the net cash value and then total paid up additions beginning year. So I'm going to scroll down in a second, but I'll just hit on these two very, very quick. So net cash value, that's your money column, how much money you have access to. You'll notice that does drop when we take a policy loan. I like to refer to that as our available equity. That's how much you can actually borrow, by the way, whatever you have in cash value. Sometimes we hear you can borrow against the death benefit. I don't like that terminology or how that's expressed, because it does make some people think that whatever their death benefit is, they can borrow against, and the death benefit is always higher than the cash value. Especially in the early years, it's a ridiculous difference. You have a $3 million death benefit and $100 in cash value. It's like, no. It doesn't work like that. The death benefit is collateralized by the amount that you borrow. However, to simplify, whatever you have in cash value, that's the equity that determines how much you can borrow. And in a case like this, we see when you take a $500,000 loan, your available equity that you have access to for additional loans does drop as a result. Then we've got total paid up additions. So this just represents the additional whole life death benefit that is purchased when you add money to PUAs. So your whole life death benefit, the net death benefit, is going to increase over time. We'll see that in the next page. But as you pump money into PUAs for cash value, you'll get added death benefit as well, which is sweet. All right. So part two. All these columns. First, we've got amount of 1 year term. So we do have a 1 year term rider that we got rid of quickly in this example. Again, because he was only funding it for a short period of time, 4 years. And then the net death benefit on the far right. I don't like how it's broken up. But again, if you're considering a policy, you should always receive the illustration as well, the actual literature from the insurance company. I do like putting things on Excel because it helps simplify things, but at the same time, we do need to have this information and we can make sure the numbers are accurate. Like whatever on Excel, we pull it from what we're looking at here. There was our death benefit drop. This was also when we took the loan out, which also dropped that death benefit. But a lot of stuff going on when we look at the detailed illustrations. But that is really an explanation of how loans work with detailed illustrations. If you're considering a loan, we can always put this together. We also have our loan workbook, which is something we do provide to clients we work with, those that have purchased the policy, which makes life very, very easy because I can just plug the illustration in. We've got it here. Adjust the interest rate if it's a variable rate, and duplicate the exact same thing. So we took a loan in year 8 for $500,000. Let's clear this. And then we applied $100,000 per year toward the principal. Now this is paying loan and interest. What would happen here? So this will apply $100K per year toward the principal. This calculator assumes you are going to pay the loan interest out of pocket each year. So a little bit different, but I mean, what you will see is when the loan is repaid, my cash value is going to be restored to what it would have been as if I never touched it in the first place. I received that constant compounding as time passes. So year 20, I'm at $2,094,000. Year 20, I'm at $2,094,000. I do hope that this was helpful. It's a technical topic. Again, if you've got specific questions on how loans work with illustrations, you may have found this valuable. If not, you may have found it very technical, but I do hope that you got some value, or at the very least, entertainment out of it. And as always, again, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.